Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. The main pattern here since September 2024, so well over a full year now, has been, though I'm now starting to look at another pattern, wasn't this despite being breached and repaired only as recently as early October, is the dark blue September to December 2024 bear channel, currently 1081 to 1546. That's developed into a descending expanding wedge pattern. The mauve medium moving average, currently at 1572, and in recent times in year a green short medium moving average, currently at 1523, have also helped cap the market on occasions. Both are today paralleling either side of the dark blue upper trend line. There are two other patterns that have greatly influenced this market. The first, and the one that I think may be taking over as the main pattern here, is the bright green late September 24 to late February 25 bearish shift pitchfork. I drew the original bearish Andrews pitchfork for this move some 36 weeks ago, as it seemed back then to be a better contender in showing the bearish angle of attack. But this did not last, and I finessed it into what we have now, the shallower bearish shift pitchfork for the same move. Today we are just underneath the overhead bright green middle time, currently at 1524, having tested it late last week and seemingly rejected it today. The second pattern is another, larger bearish pattern, which I have also previously spoken about, and a good contender even now in showing the bearish angle of attack. It is the longer term, bright red, November 23 to September 24, similar but slightly shallower, bearish shift pitchfork. On this one we are just above the bright red middle time, which is currently at 1449, as well as being a little above the March 21 low at 1466. Now 5 weeks ago we had a break below the bright red middle time, pushing down below the previous significant low in late June at 1468, down to a new low, one that had not been seen since December 2020. Indeed, we dipped down to that December 2020 low at 1409 for around 3 weeks. However, each time it was tested, prices backed off higher from this low, because, as I said 5 weeks ago, and I quote, "We have support on the downside on congestion based around the significant 61.8% absolute Fibonacci line for the 21st century at 1383, which stretches from 1409 down to 1379. All that is needed for these to be tested is stabilization under the bright red middle time." End of quote. Well, we had that stabilization and nothing much happened. So the market started to move back up again, unsurprisingly. So now we are seeing prices seemingly on top of the bright red tine and the March 21 low, but below the bright green middle tine and the green short medium moving average. Now looking further down, well, we really don't have that much support until around the 1248 level, and I'm not too confident down there as well. We also have a cap between 1336, a gap. We also have a gap between 1336 down to 1320, dating from September 2020. So a lot has depended on that congestion support between 1379 to 1409 to keep the market where it is. On top of all that, October was a monthly key reversal down, a bearish factor, though, as I said last week, and I quote, "I can't help thinking that maybe such a pattern could be seen as a swan song. However, until otherwise, the pressure is still on the downside." End of quote. I say the pressure is still on the downside, though we seem to have undergone a small mild retracement on the upside, which has hit some solid resistance overhead. And that may be enough for now. However, I can't help feeling that this market is going to get squeezed, and maybe squeezed lower. Ice Europe, white sugar in London. After all this time, there still continues to be 3 features of this market to keep bearing in mind on this daily chart. The first of the 3 features is the obvious broken, repaired, broken again, repaired, and lately breached, if not broken, purple late September 24 to mid-February 2025 descending and expanding wedge pattern, which is currently 1431.20 to way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary made back in January this year, and had earlier been severely tested on the top side, enough that I would not necessarily classify as a descending wedge pattern after February, though I continue to still keep an eye on the extension to the purple upper trend line. As it is, bar some congestion at 425.5, the nearest support and resistance of this market is that level, that upper trend line. Next, I also asked you 31 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then, the market initially started utilizing the bright pink tine of this bearish shift pitchfork, currently at 454.60, as an attractor, riding prices lower in a shallow glide until early October, when it started a further steeper journey lower, such that in early November the market had been closer to the pink lower tine than in early November. Lower tine currently at 396.20. However, we have seen a pull back upwards since mid-November, and this also this has only been capped late last week, and even today by the combined purple upper trend line and especially by the declining green short medium moving average, currently 436.5. The third feature, which developed since the beginning of September and late 3 weeks ago saw prices break above it, is the red early September late to late November bear channel. This bear channel had been excellent at showing the very recent bearishness of the market, including 3 weeks ago the lowest low since December 2020. However, that same week prices broke above and out of it, and late 2 weeks ago stabilized over it, such that last week I laid out possible targets for this pattern on the top side. For primary target X up in the 447.40 area, and a secondary, harder to achieve target X1 up in the 454 even area. I'm still not too sure about these two targets, as the green short medium moving average has been very effective in seemingly batting prices back down, but for now they still stand above. Sugar white premium spread. This one has been a disappointing one, not because of the market doing the opposite of what I thought the patterns might indicate, but because the market has instead done nothing, or at least nothing much. 11 weeks ago I said here, and I quote, things seem to be trying to resolve themselves into a pattern, and over the intervening weeks, end of quote, and over the intervening weeks they seem to be doing just that, though not always the way I imagined they would, or even into a clear resolution. You see, I thought we might be moving towards, as I cautioned for a number of weeks, and again I quote, I have a fear, it is a real fear, that the whole 2025 today action could be trying to form a possible diamond pattern, end of quote. I continued, and I once again quote, this would be a large pattern in time, probably from February to November this year, and in height roughly between just under 100 to up to 150. It's too early to say if this is happening, but I would urge you to keep an eye on such a possibility, end of quote. Well, that possibility looked real until 11 weeks ago, when the market dropped down and below what I thought would be the lower bullish trend line highlighted in dark blue. The market not only dropped below this trend line, and let's be honest, it is an unjustified trend line, but went on further to drop and close below the gold long moving average, currently at 106.5, stabilizing further down, dropping and closing below a new support line, the bright red neckline currently at 97.5, of a new, simpler pattern, which the market opted to utilize instead of the more complex diamond pattern. It became a February to early October head and shoulders top. The issue I had, and still have with this pattern, is that we are now past the early stages, and we really haven't confirmed a move either higher above the gold long moving average or lower below the bright red neckline extension. I chose 7 weeks ago to lay out some potentials below for such a head and shoulders top pattern, just in case. Thus, the primary target X is down in the 70 even zone, with a secondary hard to reach target X1 down at 43 3/4. You will easily note that the primary target X is at the lower end of the congestion between September 24 to January 25, between approximately 70 to 85. Since then, nothing, or at least nothing much. We even had a weekly key reversal up 3 weeks ago, which failed to follow through and instead ended up with a combination of a hammer pattern, which is usually seen as a bullish pattern, though not always, and also a week 2 and a 2-week descending hawk pattern, a bearish pattern. Thus one was actually contradicting the other. It all still comes down to what I said 7 weeks ago, and I quote, "Only concerted, consistent and longer term moves above the bright red neckline and ideally over the slowly rising rising long moving average, the gold one, could possibly assuage the bearish potential, at least as far down as the 70 to 85 congestion." End of quote. We have been half there and half not there. And the last 3 weeks' actions just exemplifies these half in, half out contradictory courses of actions. It is indecision, but on a much, much larger scale than on a weekly chart can really show.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.